Okay, so it's been a very long time since I posted. There's just been so much going on. So I haven't really had a lot of time to do it, but I gotta get it done. It's taken too long. So you guys get me with wet hair today. I just came back from the gym and got cleaned up. So um, gotta keep up on that health. So, anyways, all right. So much to discuss. So, this one is just going to be a pretty broad economic update. The Fed is meeting next week, the 17th and 18th, to have their start of their fall meetings. We'll see how that goes. Okay, so let's kind of rewind the clock back to the last meeting. I can't believe Jerome Powell and the Federal Reserve members decided that they were going to cut. Um, it was totally uncalled for. I did not agree with it in any way, shape, or form. I had told you guys that I didn't think they would cut it, but they actually caved to the White House administration. And the reason that I say that is because there was, again, no reason for them to make this cut. Um, and it was pretty blatant and pretty obvious that they had caved to the White House administration, so much so that after the Federal Reserve press conference, the the four previous chairs of the Federal Reserve wrote a letter, took out an ad in the Wall Street Journal. All four of them signed it, and Wall Street Journal printed it. So it was Volcker, Greenspan, Bernanke and Yellen. So the four previous chairs that are still alive, they signed this letter saying that the White House should not be interfering, that the Federal Reserve does not cater to any administration, does not cater to any political parties. I mean, it was a full-on slap in the face of the White House administration, and then a backhanded slap against Jerome Powell because he shouldn't have caved to the pressure of the White House. And what that letter really shows me is that they also did not feel like the cut should have been made. If they felt that this was really justified, I don't think they would have written that letter, because that letter was solely just about the fact that the White House was putting on pressure to cut the rate. And the Federal Reserve, that is not their mandate. As I've told you 1,000 times, they only have one mandate: stabilization of the U.S. economy. And again, they do not answer to political parties. They do not cower down to Congress or the White House administration, but yet this is what Powell did. And so, again, it wasn't justified. It shouldn't have been done. I don't think it was a very good call. There's talk about the inverted yield curve, which, again, I promise I will do a video on this. But the inverted yield curve in the past, as I've said before, has been a really strong indicator of recessions. And the reason I feel like it was a great indicator of this is because nobody really paid attention to it. But once you get people paying attention to it, now it's going to start impacting it, because people are going to change their behavior based on that information, which then now will influence the inverted yield curve. So this is where I'm like, so in the past, it has been an excellent indicator. Going forward, if people keep putting really heavy weight on it as they are now, and they adjust their behaviors accordingly, I don't know that it's necessarily going to be as good of an indicator. It could still be a really good indicator, just maybe not as concise. And I feel like we're seeing that now, because we have seen the yield curve inverted actually for a while. I've been hearing about it for like at least 2 years. And we still haven't hit recession status. So this is where I'm like, I think because people now are aware of it, it's changing their behaviors, investor behaviors, and it's not going to be not maybe as clear of an indicator as it was in the past, because in the past, no one was paying attention to it, so it was just doing its thing. And it was really showing the information of the economy at that point. But now people are watching it, they're tracking it, and reporting on it. And because it's being reported, then individual investors and institutional investors alike are adjusting their behavior accordingly, which then might not really cause or really be indicative of what we're seeing in the economy. So this is where there's some back and forth on that one. So again, there isn't any real indicators that the economy is in distress. It's doing really well. Unemployment's at 3.7. We haven't seen that in decades. So overall, the U.S. is good. Housing market is slowing down. Again, it's justified because the housing market has just kind of overheated. And so it's good that it's pulling back some, at least in some of the major metropolitan areas. Now, it's not overall as a nation pulling back, but you've got the major metropolitan areas like New York and Chicago and San Francisco. They're starting to pull back a little bit, and that's not necessarily a bad thing. So what else? Oh, yes. So China. I've told you guys for months, actually, not just weeks, but months, that China actually can't afford a trade war. And they still can't. This is why. So they did try to put it into war status. I've told you guys before in the past that it's been just a dispute. It's been kind of this trade tit for tat. It wasn't necessarily a trade war. What happened though when Trump decided to add additional tariffs and China's like, fine, we're going to devalue our currency. That pushed it into war status. Now we still haven't fully seen that going. All these talks, big talk of tariffs and all that, go into full effect. We've definitely seen some of it, but we haven't seen it in full effect. But and now again, they're looking to meet in October to talk. It's still a dispute. The fact that they're really trying to find common ground to make this work, that it just shows it's not a war. It is still a dispute. Now, again, China can't afford this. A lot of people are like, well, China will just wait out Trump and then they'll just go ahead and do whatever they want with the new president. I get the logic behind that thought process, but you're assuming that they can hold on to doing this for 4 years, and they actually can't. And so they do want to definitely have a discussion and try to resolve this. The problem is that you have both China and the U.S. going into these trade talks with the wrong mentality. So they're going in there thinking this is a zero-sum game, meaning that if China gets something, then the U.S. is going without. So China gets something, then we get nothing. Or if that the U.S. gets something, then China gets nothing. That is not how this works. It's a trade negotiation. It should be that both parties come out with, being better off with trying to mitigate some of the negative impacts. But really, this could be what's called Pareto efficient, meaning both or all parties involved could be better off with nobody being worse off. It really can be that way. There's enough, good grief, people, there's enough commodities, there's enough goods and services, there's enough currencies, there's enough food, there's enough everything that we could go ahead and make a good trade deal with China and vice versa, and nobody would be worse off. But yet they are so adamant about going into these trade talks as a zero-sum game, and that is the problem. You have really more of a vanity of the egos than you do a trade dispute. So again, for the U.S., like I've said before, this is more of a political stance than it is an economic one, and for China, it is both political and economic. So So that's where that's at. And again, like I've said before, China can't afford this. And so they are definitely eager to get this a little bit more resolved. Um, Oil, that's another one that needs to be discussed. Oil prices are going down. Okay, which is interesting because it shouldn't have happened. So back in August, if you guys remember, Iran was basically hijacking tankers everywhere. Okay, in any other kind of reality, had Iran done that, it would have jacked up oil prices to at least $100 a barrel, if not more. The fact that they were hijacking tankers and causing all these problems, it should have buoyed the oil price. It did not. It actually just kept steady, pretty much. It went up a little. I mean, there were little upticks, but not in leaps and bounds like we would have anticipated. And that's largely due to the fact that, again, the world economies are trying to go off of fossil fuels. They're not consuming oil in the same manner as they used to or in the same quantities. On top of that, the US is definitely pumping out its own oil. And so when Iran was doing this, we're like, well, we don't care. We still have our oil. So the US really wasn't impacted by this. In fact, the vast majority of oil prices around the globe were not impacted by this. I would venture to say, now you might consider this kind of a conspiracy theory or whatnot, but I would kind of say that Iran was in cahoots with OPEC for causing this debacle. So, because you didn't really hear, I mean, you've heard OPEC say, oh, like, don't do this. Like, oh, don't take our oil tankers. But I think they were more than happy that this conflict was arising because they were hoping that that conflict and the news of Iran doing this with taking tankers, that it would cause oil prices to go up. And so there was a I can't remember if it was an article, if it was a podcast, but anyways, there was an analyst that said, really, for the OPEC countries to keep their economies at the same levels that they have been at, to keep it going and to continue to provide the growth and support the growth that they've had, they really need oil to be about $80 a barrel, which we're not happy with. That would be ridiculously high. We're at what, 50, like 55, $60 a barrel right now. So actually, I think we went down lower. I think we're closer to the mid 50s to lower 50s. But yeah, I mean, they need those oil prices to be up higher to support their economies. So again, although they were like, oh, Iran, this is horrible that you're doing this, they really didn't take a lot of action against it. They didn't really have a show of force. They didn't, I mean, they came out and made kind of a press conference statement, but it wasn't strongly worded. I mean, there was really not a lot of kind of condemning Iran for their actions. Even though they said it, I guess to some extent, they weren't really forceful about it. I mean, somebody's taking your tankers. Like, another country is taking your tankers unlawfully. That's money. Basically, they're stealing money from you or holding it as ransom. You're not going to be a little more outraged about this, and they really weren't. And so that's why I'm like, I really wouldn't be surprised if that was the case, if they were kind of like in cahoots with each other, and Iran saying, "Hey, let's cause this conflict," and OPEC's like, "Sure, that'll help. That'll help with our oil prices." So, but it really didn't pan out because oil prices did not really budge upward in big leaps and bounds by any means, and so that's where it didn't quite have the effect I think that they were hoping that it would have. And again, that's various factors, just like anything else in the economy. It's not one factor; it's multiple factors. And one of those factors is that, again, we don't consume oil in the same manner that we used to. And then, of course, we're pumping out our own. So there's that. Oh, yes. So Bernie Sanders coming out with his own Green New Deal. AOC continue to keep pushing her Green New Deal. Still no funding for it. Still no funding mechanism for any of this. And they keep just thinking we can print the money and it's fine. Again, they're not understanding that would work in a closed economy. The U.S. is not a closed economy. In fact, almost no country in the world is a closed economy. Everyone trades with each other, which means our currencies also trade and they fluctuate. So we can't just print endless money. That's not how that works. So, and they're assuming that these costs are fixed, and they're not. They're going to be increasing, and so I don't think that they accounted for some of that in their plans. And so these are some of the major headlines that I've been reading about that I feel are pertinent to the markets and affecting the direction the U.S. economy is going. So there's the update. This video was a little bit longer than normal, but I hope that was a lot of good information. Again, the Federal Reserve is meeting at the 17th and 18th, so Tuesday and Wednesday of next week, and so we'll see what the Federal Reserve does. Now, I feel like Jerome Powell, when he announced the rate cut last time, he really did try to backpedal from that afterwards, when he's like, oh, well, it's a mid-cycle adjustment. Don't expect this to be the norm. Don't expect us to be constantly cutting the rate and blah, blah, blah. But then there's still a lot of speculation that he's going to be cutting the rate this upcoming meeting. So we'll see how that goes. Only time will tell. You can't even try to make sense of which way they're going to go. It's after the last surprise, after the last meeting, and the surprise that they pulled out, I was quite floored, because I did not think that the data actually supported that type of movement. And we really don't have a lot of room to run if we do run into recession. If we run into it sometime next year, we really don't have a lot of room to run. So that's where I'm like, I don't know that that's the best course of action. There were two governors on the Federal Reserve Board that they openly dissented from the decision to cut the rate. They had supported the movement to keep it steady and not move the rate down or up, but keep it as is. And they openly dissented from the rest of the group. And so that is the first time since Jerome Powell has been in that you had governors that openly dissented from the group decision. Now, that's not to say that it doesn't ever happen, of course. Federal Reserve board members have disagreements, and they've openly dissented before, or even openly criticized decisions that were made by the Federal Reserve Board, or by the Open Market Committee, FOMC. So that's not unusual, but this is the first time that he's had it happen since he took office. So in the last 3 years, he hasn't had anyone openly dissent or publicly dissent, and now he has. And so that just goes to show you where the Federal Reserve is. You've got some of them in support of rate cuts, some of them not. I think having the previous chairs send out a letter and all four of them sign it, I think that is, it's giving other board members some pause before they really decide, which other direction that they want to go, if they want to keep with the rate cuts or if they feel like they don't need to be doing this. Because again, all the indicators in the US economy do not justify this. All the numbers are really, really good. So we've had good GDP, growth is still happening in the US. Globally it's slowing down, but after a lot of the growth what we've had, yeah, it's just, that's to be expected to have a little bit of pullback, but we're not having such a pullback that it's going into recession territory or that we're coming to even stagnation. We are still going forward. We're just not going as fast. Well, the US is still doing really well, but other economies, maybe not so much. And so there's all of that. Hopefully that gave you guys a nice broad overview and an update for get you all caught up for what's going to happen next week. And if you have any questions, as always, put them in the comment section below and hit that subscribe button, and I will talk with you guys later.